When considering a company acquisition, due diligence is a crucial step that involves thoroughly evaluating the potential investment to uncover all important facts. This process is especially necessary for buyers involved in mergers and acquisitions, as it allows them to understand the true condition of the business before finalizing the purchase. Due diligence usually begins after the signing of a term sheet, once both parties' lawyers have agreed on terms, enabling the buyer to access detailed financial records and business data. To do this effectively, it's essential to hire experienced legal and accountancy professionals who specialize in acquisitions. Lawyers will review legal documents like the Certificate of Incorporation and Articles of Association, while accountants will analyze the financial statements to identify any issues or risks. This careful examination helps ensure that the buyer makes an informed decision based on a clear picture of the company's health and operations. It's important to identify all the geographic locations where the company operates to get a full picture of its business scope. The accountant will need to gather key financial documents, including statutory accounts filed with Companies House, corporation tax returns, and VAT returns, as well as review the general ledger, chart of accounts, trial balance, management accounts, and budgets. Having 3 to 5 years' worth of actual financial data, such as profit and loss statements, cash flow, and balance sheets, will help establish an accurate financial position. Supporting documents related to assets and liabilities, like loan agreements or property deeds, must also be reviewed. Independent research is crucial to uncover any negative press or reputation issues, which could impact the acquisition. Interviews with management and key accounting staff will shed light on operations and internal controls, which are essential for business performance and may reveal opportunities for improvement. Understanding the terms of major customer and supplier contracts will highlight if they are reasonable or if there's room for enhancement. Contracts lasting more than a year should be carefully evaluated to assess revenue stability and business development potential. Transactions involving shareholders or insiders need scrutiny to ensure transparency. Reviewing the company's articles of incorporation is necessary to identify any purchase constraints, and minutes from board and stockholder meetings over the last 3 years should be examined to understand governance. Materials distributed to shareholders and directors over the past 5 years can provide additional context. Finally, it's key to check the jurisdictions where the company is licensed to operate and to review management reports or valuations from recent years for comprehensive insight into the company's standing and prospects. Start by reviewing the company's brochures and reports to get a clear understanding of its products and overall business. It's important to look at organizational charts and policy manuals, including corporate codes of conduct, to understand internal structure and governance. Next, check the company's memberships in business or trade associations and review any related documents to see their involvement and standing in the industry. When it comes to financial controls, review the list of bank accounts and authorized signatories to ensure proper oversight, and thoroughly reconcile bank statements with the accounts. Understanding the markets the company operates in is crucial, so assess the target market segments and total market size for the company's products and services. Identify major competitors, outline their products, and analyze market share to gauge competitive positioning. Review the current marketing and business plans for each product or service line to understand strategies and plan changes. Look at market research and customer surveys, including studies on geographic expansion or new product ideas. Analyze specific products or services sold in the past 3 years, focusing on gross margins and historical sales data. Assess production capacity at each facility and how fully it's being utilized, noting any excess capacity that could be redirected. Evaluate pricing strategies, how prices compare to competitors, and consider alternative approaches if needed. Identify distribution channels used for each product or service and explore unused or new channels that could improve sales. Collect and review labels, packaging, advertising, and promotional materials from the last 5 years to understand marketing efforts and potential opportunities to boost sales. Examine warranties offered on products or services over the past 3 years. Finally, compile details on the company's top customers, including annual sales, discounts, promotions, payment terms, rebates, and referral fees to understand customer relationships and financial terms. Looking closely at customer churn over the past 3 years gives us vital insight into why customers might be leaving. Often, this can be linked to what competitors are offering or a marketing strategy that hasn't adapted to market changes. Understanding this can reveal opportunities that a new owner could capitalize on to improve retention. It's crucial to assess the company's current valuation without considering any potential enhancements, so we have a clear picture of where it stands today. From there, we can identify strengths, weaknesses, opportunities, and risks, which helps in making an informed acquisition. This approach maximizes the chance of buying a company with a solid footing and clear paths for adding future value.